Benzinga Nation, welcome to another episode in our virtual webinar series. This one's one that I'm always excited about. When we talk about real estate, there's so many different angles and ways to take a look at it. Today's focus is going to be property prosperity in the digital era. I mean, think about it. I know you've done it because I've done it too, where we just go on Zillow and look at the houses and the condos that we want to look at. I look at penthouses. I want to one day, be living in and dream of that as well. So there are a lot of different angles that we're going to cover here today. We've got great company, great individuals, one of them with a beautiful view that I'm definitely jealous of. But let me go ahead and bring up my man, Kevin, because I know he's been in this business for quite some time as well. Kevin, I know you've looked at Zillow and I know you've looked at houses that you want to one day live in if you don't already live in one, right?
Oh, absolutely.
Yeah.
Yeah, I mean,
go ahead.
I was gonna say, I mean, that's how people dream, right? I mean, you're looking at all these beautiful properties in, amazing locations.
Yeah, I mean, I would love to just go ahead and stock trade one day and just go look out with a beautiful view. But before I go ahead and hop off, though, what do you kind of get most excited about? You've been in the real estate business for quite some time. What do you love about it, especially in this digital era of ours that we live in?
Yeah, I mean, when you look through all the history, real estate has been the primary source of wealth, right? But also throughout all the history, that wealth has been concentrated to, very few. Now in our digital era, that's already changed, and it's changing more, where more people, just average, individuals who never really had access to real estate ownership, now do have these opportunities to, and not only invest in just, rental properties or, small assets, but huge, beautiful properties that only the most elite and wealthy people have ever really had access to.
Well, I love that you said that because you talked about having had access, and how your guest coming up right now has provided that type of access to a lot of people raising multi-million-dollar deals. But it's all you, man, to go and introduce our guest speaker.
Yeah, thank you. So we have the executive vice president of Cardone Capital, Ryan Tseko, the man who, has been building and managing Grant Cardone's, massive real estate portfolio. So welcome, Ryan. Great to see you.
Great to be seen, and thanks for having me. I know Zuad and you were mentioning the view. I mean, look, all real estate's not created equal, but I'm here to add value and here to provide a service. So thanks for having me, Kevin.
Yeah, thank you. I love your story, and, I'd love to, touch on a little bit. I mean, you didn't come from, the background in, finance and fund management. I mean, you're a normal dude. You're a commercial airline pilot, right? How did you go from that to, where you are now?
Well, look, so my uncle was a builder when I was a young guy, and I've always been fascinated by real estate and building and really growing. And so real estate was always that platform for me. When I looked up, I was, 17, 18 years old. I wanted to do my first deal. And I looked to my uncle and he's like, well, Ryan, you're broke. You don't have any money. So I turned to flying because he had an airplane. And my first career, as you mentioned, was actually a commercial airline pilot, where I found a lot of great mentors and learned a lot of great things about, checklists and, very, very analytical. Being a pilot, there's a lot of skill and a lot of attention to detail that goes into that. When I hit 30 years old, I said, what's next? Because I wanted to get back into the real estate game. And at the time, a lot of the rules and regulations were changing. And I also, Kevin, one of the things that I want to mention is that when I joined the airlines, the 401ks and these different retirement plans, like, it just never made sense to me. Like that was not the route that I wanted to go. So I always wanted to be invested in real estate because I didn't want my father's retirement plan. Like, I knew that was broken. I knew that was never going to work. And so I wanted to get back into the real estate game. And at 30 years old, I found Grant Cardone on YouTube. And I said, man, if he's buying an airplane and he's already got a portfolio of 3,000 units, this would be perfect for a guy like me to use the skill set that I already have and then go and help him build something massive where we could also allow other people to invest in these deals that have never, like you mentioned in the intro, people have never had access to these institutional quality deals until about 8-9 years ago when the Job Act passed.
Right. So, tell me, like, what have you done, since you've been there, though? Tell me a little bit about, the portfolio and the properties that, you guys have, acquired.
Well, look, we acquire a lot of core, very nice Class A, just great located properties. When we started with our first deal. It was 192 units. The deal was $20 million. We did 15 million in debt, 5 million in equity, oversubscribed that. We're now on close to deal 40. We have almost 13,000 multifamily apartments, and really we focus on Florida, Texas, and Arizona, the Sun Belt states. And look, we built this one deal at a time. This is not something where it's like, oh, you just snap your finger and the investor portal pops up, or you snap your finger and you have all these deals. We have Regulation A, which is the non-accredited fund. We have Regulation D, which is the accredited fund, and we run both of those parallel. And we've really been able to grow out a fantastic portfolio. And Cardone Capital is now one of the leaders in crowdfunding.
So how to buy, I mean, I think I saw you've raised what, 1.2, 1.3 billion dollars. I mean, that's a lot of money. That's more than the market cap of many publicly traded REITs. I mean, that's serious. That's significant. How are you raising this money? Like, where are you finding all of these individual investors? And then not just finding them, but getting that trust for them to invest their money with you guys.
Well, a lot of people know Grant Cardone, and when we started our first fund, he had probably 6-7 million followers on social media, because Reg D 506C, you can now do crowdfunding as long as they're accredited and they with a third party to give you the validation. That has completely changed the game when it comes to raising money for real estate, and we've really just built it off of Grant Cardone and his platform and his not followers, but truly friends on social media. And we have now converted them to investors. Kevin, here's what we're finding. A lot of it doesn't matter the age, right? From 20, 30, 40, 50, 60 plus years old, we're seeing a lot of people, they want equity. A lot of people want to take their money, and again, they don't want to invest in the 401k. They want to invest it into a real asset. So when people see these deals, they're like, wow, I could never go and do that deal on my own. I could never go and find it, fund it, do the debt, and also manage it. Because as you know, property management is pretty intensive. And so what happens is we allow them to come in to these deals as a partner, as an investor. And that's really how we've built this. We've had a lot of referrals. We've had a lot of recommendations. And then also you think about it, right? As part of our platform, we also have a lot of business owners. And as a business owner, you make a lot of money, but you don't have the time to go and invest in real estate. So I truly, I want to just share with people, sometimes these partnerships are the best thing in the world, because when you find a guy and you find a team that has the best deals, sometimes the easiest thing to do is take the money you've earned out of whether it's your job or your business, and invest it in deals that are already baked, already done.
Yeah, absolutely. That makes sense. So, tell me, right now, I mean, I can't even think of a short, easy way to describe the market lately. I mean, there's so many things that have been happening. So where things are right now, I mean, where are you seeing the opportunities? What are you guys targeting and are looking for?
So we are buyers in all markets. What I'm finding right now is that debt is the biggest issue in the real estate marketplace. When debt goes from 3.5% to 7.5%, it's a 400 basis point, plus spread. What I've seen right now is cap rates have, gone 150 to 200 basis point spread, but we're still seeing a little bit of a disconnect between buyers and sellers. What are sellers willing to sell for? What are buyers willing to pay? Because in these big real estate deals, what you see a lot of, depending on the market, depending on the location, depending on the quality of the asset, is you want to get leverage that actually helps the deal, not hurts it. And so I don't know, Kev, the talk of the town is there's $2.2 trillion of debt coming due in the next 3 and 4 years. I honestly believe that there's going to be issues when it comes to these deals, and I don't think there's a way out for some of these deals, especially office. There's going to be a lot of pain in the office market. If occupancy stays where it is and interest rates stay where they are, I think we're going to see a lot of deals coming back to the market at a steep discount.
Okay, interesting. So I'd like to talk a little bit about some of the, the assets that you guys, have already acquired, as well. I know I've seen some, some beautiful properties. I think we have your website up here. Yeah. What are we looking at? I mean, what are, and what stands out about these assets? What are you guys, I believe you guys, maybe do some renovations to them, you rebrand them, talk me through that a little bit.
Well, look, what you're looking at right now is you're looking at a couple assets in South Florida. South Florida is a state that has great rules and regulations. A lot of people, migration, we look at migration patterns, right? And I think a lot of investors should look at migration patterns. There's an easy saying in the Rule Book 101, where the people go, the returns go. We have great assets in great locations. These are already built. So we don't do the build model. We actually buy existing assets. And so when investors come in, this is a great note, Kev. When investors come in, typically 30 to 45 days after we close on the deal, they start receiving a distribution. For the accredited fund, we pay out distributions every single month. But this is the quality. I just really wanted to show off the quality and the type of asset that we're allowing investors to come into, because I could sit up here and tell people about what we're doing, but until you see that building on Las Solas Walk, you really don't get the full picture. So these deals are available to all of us now. And that's what I'm truly proud about at Cardone Capital. It's fantastic. I mean, look at that deal. We bought that from a high institution. They were, built it to sell it. And, we've really built a phenomenal portfolio.
Yeah. I mean, those are impressive. I mean, to me, if I've got money that I can go and buy a single family rental or a duplex or get in on that property, I mean, I want a piece of that. That's a beautiful, in all of these, looking through these are magnificent. So,
and Kevin, Kevin, what I'm finding
Kevin.
also too, what I'm finding is when you're buying assets from institutions, there's less emotion to it. I don't think there's going to be a huge crash in the single family market, because people with, their fixed rate 3% and below, they're not going anywhere. They're not selling. It's putting pressure on the market. With these, when you go and buy these, there's no emotion to it. Typically the merchant builders, they build to sell. And so it doesn't matter what type of market it's in, whether it's a 4-cap market, a 5-cap market, or a 6-cap market, they're sellers. And so we're just, again, sometimes you got to find deals that are real deals. In order to get a real deal, you have to have a real seller.
No, absolutely. So, talk me through a little bit about, why these assets though? There are, I see funds that focus on, class B and C and, different like secondary markets. And, looking at these properties, I mean, these are high end, these are, looks like probably some of the nicest apartment buildings in these areas. I mean, why is that your focus when, maybe you could buy more units for less, if you were looking at, the class B and C?
Well, we're looking at a couple of things, Kevin. I think it's a great question. When cap rates in history, cap rates are never the same, right? And they started becoming the same, meaning you can go and buy a value add deal for a 5-cap, and you can go and buy a core deal for a 5-cap. If you look at those two different models, this one takes more work when you're going out there and you're buying and you're renovating, and you got more execution risk because you're hoping and praying that the rents go up. With this one, it's much more of a simple business model. You buy it, it's already done. You're really just riding the rent increases. And so I think that when you're looking at an execution rate risk adjusted, like you're looking at, okay, you're adjusting for all this, and you're just simply looking at, I'm going to go buy a better asset in a better location and just ride the rent growth instead of going out and doing, this value add. So I'm not a big believer in buying the ugly house or the ugly property and, adding value. Although if it's in the right location and the right metrics achieve that, I am willing to do it. For example, we bought a deal in Boca Raton. The rents were $2,000, and we've been able to spend 25 per unit and increase the rents to $3,000. It's a 25, 30% return on the money, but the numbers have got to work, and you've got to really, really, really like the location. So again, we'll go and buy a piece of real estate in a second and a tertiary market, but it's got to be, we never move away from, it's got to be a great piece of real estate. It's got to be a great location. And we're also looking at supply and demand, right? And then we're also right now really, really heavy looking at what does it cost to build the real estate? because there will be a housing shortage. Right now, there's not a lot of starts in the multifamily space and really in a lot of housing. And so we think because the debt market is so tight that you're going to run through the supply and then you're not going to have any starts. And so in 2 and 3 and 4 years, you're going to then have a housing shortage. And so we're going to be prepared for that. So we'll buy across the spectrum, but we just want to make sure that the return profile meets and exceeds the investors. Our number one focus, Kev, it's not Grant, it's not Ryan, it's not the team, it's the investors. We want to make sure the investors are happy with the return. We want to make sure the investors are happy with the quality of the asset.
Okay, and it sounds like they must be. As much capital as you've raised, I assume that you have a lot of repeat investors so far. I remember seeing last year, I think you record distributions, right?
Yeah, we hit almost $60 million in distributions. We send out, typically it's, 5.5, 6. Last month, I think we sent out $6.5 million to the investors. So, look, we collect the rents on the 1st and we pay them out on the 15th for the accredited fund. This is just something like we wanted to go with that model because all of us, from an investor standpoint, we wanted to get paid out monthly, not all deals pay out quarterly. And that's typically what these private equity groups do. They pay out quarterly. Monthly is just more workload, but it's, look, we're doing this because we want to create something new. We want to create something different, and we have the tools in place to do that. So here we are.
Oh, that's awesome. So, all right. So let me get real here. Like I said, you said, the real estate market's funny. You talked about all this debt coming due. So, I mean, really, is now actually a good time to invest in real estate? I mean, should people kind of be sitting on the sidelines for a little while, or what do you think?
Kev, I think it's going to be a Robin Hood moment. The next 12 to 18 months, I think there's going to be fantastic deals. If you know how to find the deal, fund the deal, get control of the deal and close it, I think in that sweet spot of, call it $20 million to $150 million deal, I think there's going to be some great opportunities. There may not be great opportunities in single family homes, especially in Miami, but I think there's going to be, with all this debt coming due, I think now is the time to buy, especially if you're going to hold on to these assets for long term. The higher the higher and longer the debt is up, the better deals you're going to see in real estate.
All right, so that sounds kind of exciting. So, what's what's the process like? So, we saw the website. Somebody goes to cardonecapital.com. They're like, I want to get into one of these deals, whether accredited or non. I mean, what's that process look like for somebody?
Well, there's two different types. So we offer accredited and non-accredited investors the opportunity to invest in these deals. You go to the website, you say get started, and then you just go through and complete a couple steps, fill out your paperwork, and you actually just send the money in, and we invest it in the deals. It's very simple. I mean, we've created something here, Kev, where people now can, within an hour, put minimums $5,000 for the non-accredited or $100,000 for the accredited. People can start investing in real estate today.
Wow, so it's pretty simple. All right.
It's much more simple, Kev, than going out and finding your own deal, doing due diligence on your own deal, walking all the units, lease out all the units, managing the tenants, negotiating the bank, the debt with the bank. All of our partnerships that we've created with, whether it's the bank or whether it's from the sellers, to even go and get this deal awarded, it feels like a complete full-time job. So I'm just telling, like, for everybody on this call, whether you do it with us or you do it with somebody else, these types of deals, I personally believe, will perform and do fantastic over the next 10 years.
Awesome. All right. Hey, thank you so much, Ryan. It always is great talking to you. So insightful. Anything else you want to, say real quick before we send you off?
No, I just think that, people need to look at, going back to the retirement, right? How do we all want to retire? Well, most of us want to retire with cash flow. So I'm here to say, I'm personally invested in real estate. I wanted to share what we were doing and how we're changing the way people look at deals. Anything I can do to help anybody, it's simple to find me, whether it's on social media or Google or Cardone Capital. But I'm always here to help. And thank you guys for running this event. I think it's an eye opener, and greatly appreciate you guys.
Awesome. Thank you so much, Ryan. All right. I think we're kicking it back over to the Aaron Bree. Where you at?
What
Hey, Aaron.
is up, Kevin? How you doing today?
Hey, I'm great. How are you?
Good, man. Good. Excited to be part of this webinar today. I know
Awesome.
you write like more about real estate than probably anyone else at Benzinga. What have you been seeing just in terms of the overall real estate market right now? I mean, I know maybe mortgage rates have come off a little bit off their highs.
Yeah. So, for so long, I mean, I don't know, last couple of years, everybody keeps calling for this housing crash, right? And no matter what the Fed has tried to do, raising the rate so much, the mortgage rates, have hit these, multi-decade highs, and still the market just isn't giving. Prices are either staying, even if they're going down a little, realistically looking at the cost with the mortgage, it's going up realistically. So, I think from here on out, whatever happens short term with prices and mortgage rates, the future of the real estate market,
Yeah, I mean,
looks stronger than ever.
Yeah, and I'm not gonna, I'm no economic expert, but I've taken basic economic classes and studies and whatnot. And I mean, when you have supply that's limited, it's hard really for price to fall that much. And at the end of the day, even if higher mortgage rates starts limiting demand a little bit, there's still not enough supply just in terms of housing in the United States. So that should keep the prices somewhat steady or elevated, even if we do see mortgage rates come back up, which I think the expectation is still that over the next year or 2 years, that interest rates should come down a little bit from where they are, which could really kick the next kind of rally in these real estate assets.
Yeah, absolutely. I mean, the thing to remember is everybody needs a place to live. Like you can't
100%.
cut back on that. It's just is what it is. So,
all right. Well, I do see that we've got our next guest hanging out backstage. So, Kevin, I'll let you take a little break and take it from here. We'll chat soon. Okay.
Cool. Thanks, Aaron.
All right, I've got Brian Daly from Groundfloor, CEO and co-founder, hanging out. So without further ado, let's go ahead and bring Mr. Daly on the stream. Brian,
Hi,
how you? Hey,
I'm
Brian.
well.
Good. Glad to hear it. Where are you joining us from? I can't tell from the background. It could be anywhere.
You can't tell it's Atlanta, Georgia?
Oh, of course. How, I can see the Braves Stadium right there over your shoulder.
For sure.
So tell me, I guess, before we get started, just a little bit about Groundfloor, brief, overview.
Groundfloor is a 11-year-old investment platform that was started in the wake of the 2012 Jobs Act to open up private credit in real estate to everyone on a fractionalized basis. We've done $1.3 billion in investment volume on the platform, serving over 250,000 retail investors now. And we've generated a return on that private credit in residential real estate that has historically been around 10%. And with higher interest rates is now something more like 12%.
Wow.
And we formatted it in a really interesting way that I think says a lot about the future of where real estate investing and private market investing is actually going. So excited to get into that.
Yeah, I'm excited to get into that too. And I mean, before you hopped on, Kevin and I were just talking about, mortgage rates and interest rates. Is now a good time to invest in real estate?
Depending on the market, where you are in the capital stack and the asset class within real estate, yeah. The thing I think I've learned about real estate now in over a decade of running the company is it's important to pay attention to where you are in the capital stack, what local market you're in, and which asset class. So I think if you pick the right spots, yes.
All right. And then how does Groundfloor differentiate itself from other investment platforms, and what advantage does it offer to investors seeking alternative investment opportunities?
Look, the traditional platforms, and in fact, even a lot of new platforms, are selling a false alternative. They tell you that either that if you want access to alternative real estate or other alts, that you have to participate in some fund structure, which we learned from public market investing that funds, mutual funds, REITs are an outmoded way to invest. So first of all, that's the first false alternative. You don't have to invest in a fund and pay the fund manager to allocate for you. and pay the fund manager to underperform relative to the market averages. That's exactly what we learned in public markets, and it's also true in alternatives. And the second falsity that they tell you is that you've got to put in a high minimum investment, or you have to, if you're not participating in their fund, you've got to invest 5,000, 10,000, 25,000 per deal and take that risk. Neither of those are true in today's world, and we have built a platform that's very different from the traditional platforms and pays that off.
Got it. So, I mean, you're saying basically, I like student housing as a
Sure.
specific sector in real estate. Instead of going to find a fund that's managing properties or whatever and investing in that fund, which is then going to take a fee, I'd be better off going to invest in these properties directly, which something like Groundfloor is helping you do.
Well, actually, what I think you'd be better off doing is indexing into it.
Okay.
And the difference between an index and a fund is active management versus passive management. So, for example, our space isn't student housing. Our space
Right.
is single family residential real estate property investment property. We allow you to index into that asset class $1 at a time. So you can very quickly via our mobile app, you put $100 into our mobile app, you can get started. You'll have a portfolio of about 100 properties right away. And these loans repay very, very quickly. So the cash flow, last year, or on a monthly basis, right now, we're repaying $16, $17 million a month to investors out of an asset base of about 300 million. So the loans repay and generate a lot of cash flow. And because you're diversified, you're not waiting to get liquid on one big investment in a property, or worse yet, waiting for the fund manager to allow to redeem your shares. So I think, as soon as somebody offers fractionalized interests in student housing, I think you should index into it. Whether an individual investor should pile into one student housing project, I don't know. What I've learned as an
Looks like we lost Brian there. His video cut out for a second, but his audio is still working. Hopefully Brian joins back quickly. Yeah. Zunaid, how you doing?
Yeah, I'm doing well. I was loving the discussion. I know we're trying to get Brian back as well, but what do you think about, would you like to,
There's Brian.
We have Brian back? Okay, look at that. He's back.
I don't know what happened. See, okay. I pissed off the incumbents.
There you go. Well,
so
Brian,
we could fractionalizing and indexing is the future. That's the way. And the false alternative that you have to pick and choose and participate in some crowdfunding scheme, $5,000 or $25,000 at a time, is false. As is the falsity that you have to go invest in a fund.
Got it. And I really appreciate you kind of, talking about some of these falsehoods that are commonly, I guess, known or understood by people that want to get into real estate as an alternative investment. Could you discuss any recent developments in terms of Groundfloor's like new offerings or market reach that are particularly noteworthy?
Absolutely. We started off with first lien residential real estate debt, and that's great, like I said, because it pays off quickly. And it pays a really high yield, 10% historically, average of 12% now. We've now expanded into more parts of the capital stack and more use cases. So a couple of years ago, we expanded into new construction, for example. You can now buy equity and co-invest with an investor who is purchasing, fix and flip or doing a new construction project. So that's new. That's fractionalized equity investing. We've done rental properties. We've done new construction. We've done some cash flows on commercial properties. So we're now fractionalizing more types of real estate, and we're fractionalizing it, at different parts of the capital stack. So I agree, it's an exciting time to be entering into alternatives. It's the vanguard of where investing should be, and we think of Groundfloor as building what for private markets in real estate, what Charles Schwab built in discount brokerage. Starting in the 70s. And I think it's an exciting time to be doing that.
So how does Groundfloor, when you're looking at some of these new opportunities, how does it, I guess, weigh different investment opportunities and say, okay, this is what we want to go into versus, hey, we're going to avoid student housing because only idiots like Aaron over there wants to invest in those?
Well, look, we have the philosophy that indexing wins. Okay. So we are providing tool sets to index into these asset classes. What that means is We're not like an active manager that's picking and choosing deals and trying to tell you, oh, this one's a good deal. You know, the problem with crowdfunding in general is that you say it's a good deal. It happens to be the deal you got. And which is it? Is it the deal you got and it's a good deal? How do I know? How do I know? And how much time is it going to take me to know? And if I'm indexing in, I don't worry about that, right? So our approach is highly algorithmic. We have a 174-page offering circular that's on file with the SEC. We have audited financials going back 8 years. You can do your own diligence and see exactly how we underwrite algorithmically in order to help you index into this asset class. And that's a very different philosophy from passive management or from active management. It's a more passive form, much like what ETFs and index funds did in public markets. That's the future of real estate investing for the overwhelming majority of people. And I just like it's what's happening in public markets for the same reasons, really. I mean, I should also mention, because of that model, we don't charge an investor any fee. You can't find a fund manager in alternatives or real estate that doesn't charge a fee. If we're making 14% on a loan, you are making 14% on.
How do you guys make money?
We make money as a capital provider. When we index into this asset class and we have deals that meet the criteria, we make money at the time we provide the capital from the investor. And they're happy to pay it, because if they're really good at developing single family property, if they're really good at it, they're making 30, 35, 40% return on equity, even if they have to pay high origination points and high rates of return, high interest rates. They don't mind, right? It doesn't matter because it comes out in the wash for them.
Got it. Well, what trends do you foresee shaping the alternative investing landscape over the next decade, and how is Groundfloor positioning itself to adapt and thrive?
So first of all, there's a whole new wave of people coming into this asset class. The younger you are, Bank of America research says, the more likely you are to view alternatives as the way to save for your future and to invest rather than public markets, right? So first of all, there's a whole new wave of people that want to interface with a new way. These people, we give you the flexibility to pick and choose and set up your own rules and basically build your own ETF, right? You can do that on Groundfloor, but we also provide a really slick and easy auto investor account where you can just download an app and the robots invest for you, keep it rolling, and keep generating cash flow and returns for you. And I think that's the future. Past is prologue, right? What happened in public markets is going to happen in alternatives. Passive investing, index investing is going to win. You know, I'm sorry to say it to my friends who are fund managers, but fund managers and their high fees and their lockups of your money via their redemption policies are going to the dustbin of investing history, just like they did with mutual funds in public markets. That's my hot take.
I do see a question from MD in the chat. He's asking about, what about commercial to residential conversions? Is that something that Groundfloor would ever get into?
I think that's a really interesting space. The research we've done says there's a lot of nuance to that business. There's a lot of nuance around zoning. There's a lot of nuance around the product development. And it's pretty market specific. So it's not a place that we're playing. You know, that's a place where if you want alpha in there, I would go find an active manager, and I would invest in their fund, to do that. Or I would crowdfund into a property if you have a thesis around that. But I don't think that category is ready for indexing yet. And I think indexing is what the overwhelming majority of people can and should be doing.
All right, running up on the clock here. Last question. Looking ahead, what are future plans and goals for Groundfloor's product roadmap, and how do you envision the company's role in shaping the future of real estate investing?
We are going to take our model and continue eating away at more capital markets, just like we did in private credit for real estate investment, that you can take it to the bank. We're going to be in more categories, enabling people to index into real estate alternatives. We are going to do that in a lot of different innovative ways. And look, we're one of the earliest to have tried this with a Reg A offering that we qualified in 2015. We're on the bleeding edge of the regulatory. We're on the bleeding edge of the user experience. And I think we are where the market's going, and we just have to take that model to more categories. And I think people who, like our shareholders, we have 7,000 shareholders who own a piece of the company in addition to investing on the platform. I think that army is going to take us into a lot of new markets and a lot of new exciting investment products.
Got it. Well, we've been on the line with Brian Daly, the Jack Bogle of real estate investing, the CEO and co-founder of Groundfloor. Thank you, Brian, for coming on Benzinga's real estate webinar. I hope we get to catch up soon. Maybe next time you guys have some big news, we'll bring you back on the show and talk about it.
Love to do it. Thanks.
Of course. All righty, guys. We're going to go ahead and transition. Going to bring my man Zunaid back on the stream. Sorry, I can't talk today. How you doing?
Really? You really think I'm good at like cleaning things? I'm really not. I can barely get myself together. You know, I was so excited about real estate investing. I looked around to see if I could find any money to invest with. I got $1. I found $1.
Well, yeah, your AMC calls didn't work out, huh?
That's a subject for another show, but I appreciate you, man. You and I will chop it up later. See ya. All right, we're going to continue the conversation with my final guest of the day, and it's going to be Christian Grothe, owner of Christian Grothe Associates. Christian, let's go ahead and talk about all the cool things that you've been doing. But before we kind of get into the nitty-gritty of it, give us a quick overview of who you are and what is it that you do.
Definitely. First of all, thank you so much for having me. I've been a realtor for about 20 years, and after so many years of finding my clients great deals and great investment opportunities, about 15 years ago, I also became a real estate investor. I've been purchasing multifamily. I've been purchasing office space. I've been purchasing a little bit of storage space. I have fixed and flipped north of 50 properties. So I've got a fair amount of experience in that space, and it's just something I'm very passionate about.
Well, I mean, I know you've been on like Wall Street. You got all these cool accolades. And, you know, I was telling the guys this earlier, but if I come to Detroit, I'm going to need you to take me to the hottest property that you've got. I need like the condo, the high rises. I need to feel like a baller for a day. Yeah, you're on air, so you got to let me do it.
We have some great things for you here. Look, and this is obviously a market where we don't have crazy high price properties like they have in New York City or you know, the West Coast. But I've been able to sell $500 million worth of real estate in the Michigan marketplace, which is pretty good for this marketplace.
Yeah, I mean, I know Benzinga would love for me to move out to Detroit, so we might need to hit you up a little bit sooner. But let's go ahead and talk about like the trends in the real estate market, right? Everything kind of shifts a little bit, but what are the current trends you're seeing in the real estate market, especially ones that investors should be aware of?
For sure. So the biggest one are definitely interest rates. You know, interest rates have been obviously rising quickly. We're hoping that they're going to come back down, but you know, we went from a 2.5% rate to, when I checked yesterday, we're about a 7.15. Obviously, for real estate investors, those rates are even a little bit higher. If you're financing certain multifamily assets right now, or even office assets, those can be in the 8% range, which would have sounded so crazy only 2.5, 3 years ago. The other thing is, you know, multifamily is definitely hot compared to office space. So that's been the other trend. Anything that is residential has obviously been pretty amazing even before COVID. COVID's made it even better. We're still interestingly crazy strong post-COVID, which a lot of people predicted once these rates are 7%, we're going to slow down. It's not been the case. We still have a real lack of inventory. And really the other trend, unfortunately for real estate investors, is a lot of us are experiencing lower rates on return on the things that we're buying now, because obviously these cap rates, as we all know, have kind of come down during the COVID area, where I'm in the Midwest, which used to have amazing cap rates. There's a lot of deals that I purchased where I had double-digit rates of return right off the bat. Some of my buddies that are doing this in New York or in LA are, you know, experiencing lower single-digit cap rates, and obviously the higher that cap rate is, the better for the investor. The other trends really are that the rent growth forecast is about 2.5% as a national average. It slowed down a little bit from that really aggressive rent growth that we were getting during COVID, but we're still looking pretty solid. And also the good news, I think, is we've got stable occupancy rates. And really where that's coming from is that so many of those people looking to buy single family residential property can't find those properties, or maybe priced out of the market, or just, you know, having challenges finding those homes. So those people are turning into renters, and that is definitely a benefit to the real estate investors who own those rental properties.
You know, one of the trends that I'm so interested in, and so, you know, I'm like 33, 34 years old. I stopped counting when I hit 21. But there's so many of my friends and so many things that I read on the news about how people my age And people sometimes, younger than me as well, are having a tough time saving enough money or wanting to invest in a single family home or anything just because prices are high. I'm waiting for it to come down. I'm waiting for it to come down.
Yeah.
Who knows if it'll come down to the price that you want it to? Because we all know once it does come down, you're like, oh, wait, is this the right time to buy or is it going lower? Point being, what do you say to those people with that mindset?
Stop sitting on the sidelines at some point, but at the same time, so that's an obvious piece of advice. At some point, you just have to do a deal. You have to try it, but really also make sure it's the right deal. And obviously, if it's your first deal, in a sense, you are doing it for practice, but always joke when I see a deal that's maybe not as financially advantageous. I say, look, we're not in the business of doing deals for practice. There has to be a decent rate of return, but age is a big factor in this. If you can start in this at a younger age and you can develop a portfolio of properties that you have mostly paid off by the time that you're 50, 60 years old, you can have an awesome retirement income. And I think you can really create a good opportunity for your future.
Yeah, I definitely, agree with that in the sense of you don't want to just continuously sit on the sidelines. You got to get in the game somehow, some way. And
right. And since we're having some technical issues, let me also identify, I think what would be useful for those investors is also learning how to identify properties that are likely, and I just see that you're back now. But if I was a younger investor, what would I want to know? How to look for properties that are likely to appreciate and likely to generate good rental income. So some thoughts to share for that. And first, I always tell people, do some market research. Look at where the population trends, where the jobs growing, what are the local vacancy rates like? Are there any major employers moving into that area? Those are things that could be really beneficial when you're looking for rental properties. The next one is, what's the location like? What are the desirable neighborhoods? Is there maybe a new hospital opening? Is there something exciting happening? Also, simple things like, are there some great restaurants? Can kids go to parks? Are there fun stores? Is there a good retail mix? Those things obviously make it desirable to live in that area. And I think if those things are in place, you're likely to have people who want to rent those properties from you. And it's even better if you can find an area where you feel that is going to grow, that those factors are going to become more pronounced as time grows. The next one is, you've got to look at the actual property. So my theory has been, I want to find properties that are underpriced in an up and coming area, because I think that's one of the greatest rates of return that I can capitalize on. Sure, I could buy some stuff in downtown Manhattan. It's going to be really expensive. Maybe it goes up a little bit more, but I think there's more money to be made when an area goes from sort of a below average or maybe an average area to a good area, going from a great area to a really great area. There's actually not that much money to be made. So that's something I think younger investors should also keep in mind, because remember, time is on your side. So there, if we can also find value add opportunities, maybe we can purchase something, we can improve it. We can make it nicer. We can make it worth more in two ways. Certainly the actual value of the property, but also the rental income derived from the property. And then really the last item of how I would identify property is also getting the right advice. Talk to multiple realtors, talk to appraisers, talk to people that are active in the market, get a mentor. It's interesting. You'll have 3 appraisers could go to the property on the same day if there's no guidance in terms of purchase price. And I guarantee you that all 3 appraisers are going to give you a different number. It is not a perfectly objective science. So really do your research, talk to different people. And I think through that, you can learn so much about these properties, and then really take the average of what everyone tells you. And I think you've got a pretty good prediction of where this may go.
Yeah, we had a transaction with a buddy of mine where we had to get 3 different prices. One was at $295, the other was at $285, and then the other one was at like $300,000. So we're like, all right, so we agreed before we went into this process that, hey, we're going to ask these 3 people, whatever the prices are, the average, that's where the transaction is taking place. I love that. Another thing that you mentioned reminded me of a story where I have a friend who wanted to open up a coding store, and instead of him doing the research on where to look at in terms of where to build his coding front, he would go ahead and find the Sprouts because he believed that they had the best research in terms of making sure their stores were in the best areas possible. So that was his research to look at Sprouts' strategy. Moving on to the next point that I have here, though, what are like some of the mistakes, right? Because we hear the good stories, we hear the good all the time, but what are some mistakes that you think new real estate investors should avoid?
Definitely. So some of those mistakes new investors should avoid, and there are really quite a few of them. Number one, maybe don't overextend yourself. Make sure that you have a cash reserve. If something goes wrong with the property, I've seen people who've done a great job. They've saved for their first investment property. They were able to purchase it. They have this house. They have a tenant. All of a sudden, the roof goes bad. The furnace fails in the same year. And they're in a really tough financial position. They don't have the $20,000 for the roof and the maybe $2,000-3,000 for that new furnace. So make sure you keep some cash reserves because you obviously want to take good care of your tenant. You want to make sure the person's got a roof over their head and they've got working heat. The other things are making sure again that the numbers are accurate. And I think through that also walk through the properties that your competition has on market ready to rent out. So many investors will buy a rental, but interestingly have never walked other rentals in that area. And I think it's really important to be aware of what is my competition offering at a certain price range? Or maybe if their properties are all really dirty and not great properties, well, I can make mine pretty nice and I'm probably going to get a huge number of tenants who are interested, who are going to be willing to pay a premium. The other one, and this isn't always, this is a lesson that I try to teach to all of my clients, especially real estate investors too, layout. And my saying is not all square footage is created equal. You can have two houses next to each other that are in the same, let's even assume it's a great location. They're both 1,500 square foot houses, but maybe one is from 1915 and the other one is maybe from 1980. They're the same size, but in this one house, maybe you've got to walk through the second bedroom to get to the third bedroom. It has no closets. All the rooms are odd shaped. The rooms are tiny. You can't fit a king size bed. And this other house built in 1980, maybe it's got a much more open layout and the house feels much more functional. So I think just be aware that not all square footage is created equal. Don't get trapped into just looking at things from a price per square foot equation or rental rate per square foot equation. Make sure that you analyze how your square footage fits into that equation.
One thing I really would have loved to do, and I don't want to say regret is a strong word, but I wanted to invest in a rental property in a college campus because that's and I have a good network in terms of that with everything I do and volunteer wise. And that's a great way for, in my opinion, it was to like cycle through and churn the folks that are living there because the college isn't going anywhere, right?
Right.
University of Georgia, it's not going anywhere. Athens is a place that's always popping, if you will. So one of the many regrets I'm sure I'll have later on in life. But I do have one question, and I think it came from the chat in terms of, where is it? It was something about flipping. Oh, here it is. Is flipping in Detroit as easy as it sounds? My answer is if the Pistons won more games, yes, but you give me a more educated one.
Okay. Flipping in Detroit is maybe not as easy as it sounds. There was a time where it was incredibly easy. I think Detroit had the best market in the whole country for flipping from 2008 to probably about 2012, 2013. It was insane. Detroit is only one of few places in the world where you could buy a $1,000 house, a $500 house. You could buy a $100 lot. And what I used to tell people back then is you could actually buy a $1,000 house and still have overpaid. That's also crazy because I think that's true in not that many places in the world. What's interesting is that $1,000 house, if it was a fairly priced house at the time back in 2012, there's a real chance that that house today in 2024, obviously it's been 12 years, but that could be a $150,000, $250,000, $300,000 house. So the rate of appreciation is absolutely insane. But Detroit, like many other markets, is experiencing a relatively limited supply at this stage. So are there properties out there? Yes. Is it maybe a little bit more challenging to find properties that have really good cash flow potential, good appreciation potential? It's a little bit more challenging, but I still think it's one of the markets in the country where it's definitely doable. Is it easier in Detroit than it is in LA? Absolutely. Than it is in New York? Yes. Than it is in Miami? Yes. I think so. And it's certainly less capital intense also.
Yeah, I'm sure, the city incentives and other types of perks that you might get out of it will definitely come into play for that. But Christian, I really appreciate your time, man. This was a great conversation. I meant it. If I'm in Detroit, I'm hitting you up. We'll check out some high.
I love that. You're welcome here anytime. Thank you for having me. Take care.
Absolutely. Take care, my man. And that is Christian Grothe, owner of Christian Grothe Associates. The man's been mentioned by Wall Street. He's done some phenomenal things, top realtor, and just a really cool fella to hang out with as well. And you at home, we want to
Alrighty, guys. Looks like Zunaid's having a little bit of technical difficulties. All good. He'll be popping back on any second. But we are going to go ahead and... Oh, you're back. How you doing?
Well, I'm good. I guess, you know what? Wrapping it up, it's always great to get different perspectives from different individuals in different parts of the same industry. So it's always great to kind of have those conversations. I appreciate you for trying to match me. That's cute of you.
I did try to match you. Well, actually... You tried to match me because I was on the stream first today on pre-market prep. So anyone that's been watching Benzinga all day saw me in my maroon sweater, quarter zip, whatever you want to call it, before Zunaid came on and tried to copy me. So
fair enough. I do watch pre-market prep Monday.
Yeah, so maybe you subconsciously was like,
maybe
okay.
I did. Maybe I did. But anyway, appreciate you, Ryan. Appreciate Kevin and all of our awesome guests as well, including Brian, Ryan, and also Christian. And we thank you, the folks at home, for watching this episode of our virtual webinar series.
Anyone else?
Prosperity in the digital era. You know what? Yeah, we'll thank Aaron, Charlotte, Drew.
Thank you, Zunaid. Thank you, Zunaid. Thank you, Zunaid.
For sure. Thank you. I appreciate it. I'm going to go practice my drum kit now. We'll see you guys next time.